Apple and Amazon are two of the largest tech companies in the world, but which one is the better buy for long-term investors? That's the question I'm going to answer in this video by comparing the two companies head-to-head across several important financial metrics, including revenue, ROIC, forward price to earnings ratios, and sharing with you my proprietary discounted cash flow valuation models, which calculate the fair value of both Amazon and Apple. So I'll do all that in this short video and answer the question which one I think is the better stock to buy for long-term investors.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
I wanted to start with comparing revenue growth because this is where we see the beginning of the business expansion for Amazon and how it eclipsed Apple in terms of trailing 12-month revenue. Amazon since 2011 has increased its revenue from $48 billion up to $650 billion. That's good for a compounded annual growth rate in that time of 21.7%. Meanwhile, Apple increased its revenue from $108 billion up to $400 billion, which more than doubled its revenue, more than tripled its revenue in that time. And that was good for a compounded annual growth rate of 10.4%, or about half the compound annual growth rate that Amazon was able to deliver in that same time. And I suspect that Amazon's revenue growth rate looking ahead 10 years, 15 years, will also surpass the compound annual growth rate of Apple in that time again. The primary reason for that belief is because Amazon is investing more sums, entering into new categories, and the categories it's operating inside, the industries it's operating inside, are growing much faster than the industries that Apple is operating inside. Most notably, the smartphone market is saturated to a large part, and you're not getting very many new customers coming into that industry. And that industry, in terms of unit sales, is not growing and is not expected to grow anytime again. The next thing I'm going to compare Amazon and Apple is on return on investor capital. This measures how good a company is at taking investor money and turning it into products and services that generate profits. How good are they at that? And the better you are, the better investment, because that's what you're in business to do. Take capital from investors, create products and services that generate profits that exceed how much it costs you for that capital. And these companies, kudos, both companies, they've done a great job here. Let's start with Amazon at 13.6% in the most recent trailing 12-month period. That's up more than double the 6% it delivered in this metric in 2016. And that's what I like about Amazon in this comparison. The trendline improvement has been excellent, and there's reason to believe that the future will continue expanding their return on investor capital as the company grows to larger size. Its cost of delivery decreases significantly because the network becomes more densified. And if you're delivering 10 packages to a street and now you start delivering 15 packages to that same street, your costs don't go up by all that much because you're already delivering packages on that street. You already have a driver, you've already allocated a truck, and so you've already borne most of the cost of that trip, and that incremental customer adds significantly to your profitability. Amazon is at that stage where it's grown so large that it's adding a large amount of those incremental customers and those incremental purchases that it's really driving its profitability forward. Meanwhile, Apple has generated 33.1% in return on investor capital in the most recent update, and that's up about 50% from the 19.5% it generated on this metric in 2016. You can see Apple has a much better return on investor capital than Amazon, and I'll speak to that. And a large part of that has to do with the fact that Apple doesn't do its own manufacturing, it outsources that. And so that's a large capital investment that Apple avoids by outsourcing. Meanwhile, because of Apple's large size and large spending power, it exercises strong negotiating power against its supplier manufacturers and therefore gets to negotiate very low prices for that manufacturing, prices that allow the company to generate very nice profit margins even on their product sales, and then, of course, even larger profit margins on the services side of the business. And that's the story that's really been driving the expansion in ROIC for Apple over the previous decade is the services side of the business. That segment generates a gross profit margin above 70%, and that's the segment that's been drawing increases in Apple's profitability, while this hardware segment remains flat or declining in profitability. By the way, I'm getting all these charts from finchat.io. There's a link in the description where you get a discount for using my link. That we've looked at the company's prospects on revenue and profitability. Let's start to look at valuation. And looking at it on a forward price to earnings basis, you can see Amazon is more expensive at 32 compared to Apple at 28. But when we look at Apple in terms of my discounted cash flow valuation model, it looks more expensive to me because I calculated an intrinsic value per share for Apple at $173. Meanwhile, the current market price is $202. So Apple shares look overvalued to me when I'm measuring using my proprietary discounted cash flow model. Meanwhile, that same calculation for Amazon shows that it's undervalued because I calculated an intrinsic value per share of $242 and a current market price of $204. So my DCF signals that Amazon stock is undervalued. So to come to a conclusion, all things being considered, which one of these two tech stocks would I rather buy today? I personally would rather buy Amazon. I think Amazon is the better investment at current market prices because all the factors I discussed in this video, including Amazon's much larger total addressable market opportunity and operating in industries that are growing much faster than the industries that Apple operates inside, and Amazon's demonstration of how its profitability improves dramatically as it grows to that next incremental customer.
Hey everyone, if you like watching my videos, then I've added a great complimentary product just for you. I've written a book that's available for sale now that highlights my 6-step investing framework. Even if you don't follow that investing framework, just reading it and knowing how I evaluate stocks will make it a lot more interesting and informative to watch my videos. I've added the link in the description below.